The Court of International Trade ruled that the IEEPA tariffs were, as applied, illegal. And so then you got into like, okay, well, the parties that were damaged are going to be able to collect on those, are going to have the government actually have to refund them. And that's when the Trump administration came in, not unexpectedly, and said, we're going to appeal this. And they issued a stay, which means, yes, the administration will continue to collect tariffs as that process plays out. I expect that will continue to be the case moving forward. I think what's interesting is, we had a lot of focus on this July 9 reciprocal date. Now, that was under the authority of these reciprocal tariffs, and USTR Jameson Greer, the trade representative, is going over to meet with many of his peers this week in OECD talks there in Paris. And presumably they were going to have a lot of conversations about trade specifically. And so does this legal uncertainty alter the approach of some of these trading partners? I think that's sort of where, again, you're seeing the administration signal, hey, we have other tools here to pursue this. So if you think somehow this is just going to go away from the courts, I wouldn't bet on that.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
Welcome to RenMac Off Script. We open to discuss markets, economics, policy, history, and life. It is the 30th of May, 2025. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account. Excuse me. And if you want to access our work as an individual investor, there's always renmacaccess.com. That's renmacaccess.com. So we had a little technical difficulty. I planted that bug so I could take over as host again. So Dutt got the adios. So, it's kind of like the back channels of politics in DC. So we might as well start with that, Steve. A lot of stuff going on with DC, including these court rulings, or at least initial rulings, that some of these tariff plans are illegal or unconstitutional, or whatever they're deciding it is. What is the meat and potatoes of this? How impactful is it? Market loved it early yesterday and then didn't really care that much. So what's the skinny there?
Well, I think the market eventually caught on to what I would agree is that the idea that Trump is just going to abandon his tariff policy because some courts tell him he can't use one of the authorities the way he wants to apply it is not going to stop Trump from pursuing his tariff policy and trade goals. I think what the courts were saying is that Trump can't use IEEPA, which was an attractive option to Trump initially because it was very flexible for him. At least he thought it was. But he has several other trade authorities he can use to accomplish the same goal. And I think once sort of markets figured that out, they figured out too that the Trump administration is going to appeal this. There's a chance they may win on appeal. But again, even if they don't, that's where they can pivot to these other authorities there. And there's probably going to be, as we've seen now, a stay, which prevents the tariffs from coming off. So I think it's sort of a nothing burger in the sense that Trump's going to continue to Trump, and that means tariffs are continue to be a factor. And I think the thing that I'm taking away is it's just more uncertainty. We're going to have now, as what are going to be these authorities used? Talking about using Section 122, which allows the president to impose tariffs up to 15% for 150 days. Maybe that's a bridge to Section 301. These are things that are more legally durable. Section 301 tariffs that he imposed on China still remain in place from his first term. So to me, that was sort of, I think, why there was maybe initial over-optimism on the behalf of markets. And I think that's where you saw things sort of recede later in the day, just recognizing that in reality, like he's not going to change.
Yeah, and so this kind of doesn't close the door. Obviously, it's going to raise. It's going to raise that he's not following the law and he's breaking the law and everything else. But they've got to stay here, right? I mean, because we've had kind of a first mover move, and now a stay on that move. Correct? That's where we are.
Right. Yeah. So the Court of International Trade ruled that the IEEPA tariffs were, as applied illegal. And so then you got into like, okay, well, the parties that were damaged are going to be able to collect on those, are going to have the government actually have to refund them. And that's when the Trump administration came in, not unexpectedly, and said, we're going to appeal this. And they issued a stay, which means, yes, the administration will continue to collect tariffs as that process plays out. I expect that will continue to be the case moving forward. I think what's interesting is, we had a lot of focus on this July 9 reciprocal date. Now, that was under the authority of these reciprocal tariffs, and USTR Jameson Greer, the trade representative, is going over to meet with many of his peers this week in OECD talks there in Paris. And presumably they were going to have a lot of conversations about trade specifically. And so does this legal uncertainty alter the approach of some of these trading partners? I think that's sort of where, again, you're seeing the administration signal, hey, we have other tools here to pursue this. So if you think somehow this is just going to go away from the courts, I wouldn't bet on that. And then I think the thing to think about coming up, it's going to be occurring over Father's Day weekend, but there's a G7 leaders summit. And I think that's where Trump and many of the larger targets here are going to be gathered in terms of his peers. And I think that's another opportunity to look for some resolution, or at least preventing the more draconian reciprocal tariffs from taking effect. So that's sort of what I'm watching for.
Yeah. Yeah. Neil, how's this affecting kind of your outlook on what you're seeing for the economy, the slowdown? We're not seeing it yet in the employment numbers. What say you on that score?
Well, I think first on tariffs, I mean, what you're really doing here is trading, well, not even really anymore, because the decision is that they can keep collecting tariff revenue. But I think, essentially it just prolongs the uncertainty around tariffs. I mean, remember with Section 122, right? There's an opportunity for them to ratchet it up to 15% for 150 days. So that's 5 months where they can basically do something without Congress, and that provides you a bridge to more legally durable or legally binding tariffs. So I don't think anything has really changed. This is what he believes. And, to the extent that there's anything important out there, it's that you just have an extended bout of economic uncertainty. And just think about it, right? I mean, the court, rules the tariffs null and void. It's like, oh, great. I guess I shouldn't have reshored that factory. And now that's been ruled null and void. Oh, oops, kind of. So it's really difficult to make decisions in this kind of an environment. But with respect to employment, look, I think the most important thing that frankly happened this week is that the level of extended unemployment claims continues to go up. I mean, that is to me the most important thing, right? So one of the kind of talking points that growth bulls have been trotting out is, well, the level of initial jobless claims is low. That's true. It is low, and that's welcome. But at the same time, that hasn't been enough to stop the unemployment rate from going up over the last number of years. It also hasn't stopped continuing claims from going up. So continuing claims are at a cycle high, and initial claims, remain relatively low. But what that tells you is that rates of job finding are very, very weak, which is why this well of unemployed people continues to build. So I wouldn't be surprised to see, permanent job losers ticking up when the next jobs number comes out. I mean, remember, this was during the survey week for payroll. So, you can't rule out, a 10th or 2/10 increase, frankly, in the unemployment rate. And I think that'll probably get people's attention.
So just around that, we talk about CapEx, and I totally agree with you. I mean, when you're making these big capital allocations to, infrastructure, your business, whatever, it's tough to do without some pathway of certainty. Are you seeing in the data, even just the early signs that CapEx is coming under pressure, or is that just not really what we'd expect to see at this point in that data? I don't follow that data closely enough, to know kind of what that sequencing is. Where do we stand with that?
Well, you had a big decline in core capital goods orders in April, and a modest decline in shipments. Survey data for May, looks mixed. I mean, maybe somewhat better at the margin, but you're really just going off regional PMIs. I just think you just go to first principles. I mean, these data points are gonna whip around a great deal because of what's going on with the markets, right? I mean, you basically had the bottom fall out in April, and then in May, you had a pulling back from the ledge, and the market responded quite favorably to that. But it doesn't mean that you're out of the woods. So you could see these sort of expectations measure bounce around. But durably, is there any reason for people to invest a lot right now? No, because the uncertainty remains high. And more importantly, the underlying trend in the economy is getting worse, not better, right? Ultimately, investment's going to follow an accelerator effect. If companies see what demand is and they invest more today, that's the basic, way. If you look at business investment, that's how it works, right? I mean, it's not about, there's another theory, for example, when capacity utilization is really high, that's when companies invest more. That's also not true, because business investment tends to rise very early on in the cycle when CAPU is very low. So, it's really about, where do you think demand is going? And if you think demand is going lower, there's less need to invest more today.
So let's bring this back to what's happening. The House passed this big, beautiful bill. I have to say I'm pretty disappointed, with the idea that we can have some type of austerity, and can we finally be, I'll say it, adults, and just understand that we can't spend our way into prosperity. That doesn't seem to resonate. And I guess that just belies the fact that politicians are weak and they refuse to do what needs to be done until their backs are up against the wall. I mean, it's pathetic. I'm disgusted by the whole thing. But the Doge efforts, as an example, right? No permanence to those. Kind of a waste of time. I'm sure Elon is disgusted with the whole mess. Where do we stand? Is there any sense that the Senate's going to push back? Is there any sense that Trump is going to, use the cudgel to cut some pork out of certain things, or is this just politics as usual? And here we go.
Unfortunately, I think it's more the latter. I mean, with respect to Elon Musk, we're recording this Friday. I believe it's his last day. I think he's having a send-off there with President Trump. I think, objectively speaking, Musk came in talking about wanting to cut trillions of dollars, but he had a lot of limitations put on him. To your point, Jeff, not being able to go after the real drivers here. This is the entitlement spending. And then even then when he tried to look at defense, sort of the politics got in the way too. So, just another example of somebody that comes in here trying to drain the swamp and in fact is more or less drowned by the swamp and sort of whimpering out. With respect to the bill, the Senate is going to make some modifications. I think it's probably going to, from a deficit standpoint, make the deficit situation worse as opposed to better. I think, House Republicans with some of their tax provisions, did put in these sunset clauses so that it would score better. And I think that's where the Senate's trying to come in and provide permanency, which on the business side may be welcome to provide more certainty as to your environment. And maybe as Republicans will say, is that the Congressional Budget Office and others scoring the bill aren't necessarily capturing the growth that they think is going to happen from this. But I think the reality is, you compare this bill in 2025 to the one in 2017, you don't have the growth drivers. And you're really talking about avoiding a tax increase because you're really just talking about extending most of the current policy, whereas before you did see a reduction there. And I think maybe those arguments for growth may have had more merit. That's probably more in Neil's lane. But, I think when the Senate tries to make modifications, they have to be cognizant of the fact that the House Republican majority is so fragile and so small. In order to just being able to pass that bill to the again, considering that as to, okay, what realistically can the House pass again? And I think that's Speaker Johnson's message to his Senate colleagues is, hey, don't make too many changes here because you saw how difficult it was me just to send you this bill the first time. So I still think the cost politically of not doing anything is too great. Again, you really just want to avoid that $4 trillion tax increase. So I think they're going to get this done. My guess is it's going to be before the July recess before the August recess, as opposed to the July 4th recess. But I think from a deficit standpoint, it's going to get worse.
Well, the bond vigilantes haven't kicked in yet. We've got the 10-year yield right now at 4.41. That's as of Friday morning. Really anything starting to get above 4.75, I would say, is bond vigilante esque. So we'll continue to watch that. But, it's interesting just from the chart formation. I mean, if you told me if you ask me for my opinion on the 30-year, the 10-year, the 2-year yield, I'd say 30-year about to break out. If it was Nvidia, I'd tell you to buy it. It's a good. That's the yields, by the way. It looks good. 10-year yield, kind of range bound, probably a little bit more to the upside in terms of the trend of yields to the upside, but not definitive. And then the 2-year yield is pretty obviously still in a downtrend. So you've got a much different view of the bond market depending on where you sit in terms of overall duration. Neil, where are we in terms of housing? I mean, is this going to get to the point where we're just going to choke? And you kind of see it, don't you, incrementally at the most discretionary of spends, those that are most tied to rates, as you should. Those are the ones that are the weakest in the equity markets. There are a few that are kind of defying gravity. But in terms of pinpointing that or drawing the thread from the rates to the data that you're seeing in those drivers, how impactful has that been so far? And, is it going to continue?
I think the big story is that the housing market can't really work with interest rates, hovering at maybe even slightly below 7%. Like, it just doesn't work. So, and you're seeing that pretty clearly in the data. Now, I think what's interesting now is that, sellers are kind of getting a little bit exhausted, and they're just, making it more price concessions to move their homes. And you're seeing, inventories also go up in the, because homes are sitting on the market longer because affordability remains a problem. You're seeing the sort of stock of resale inventory rising, and that's weighing on prices. I think that's really the big story right now, particularly in the South and West, which is important because that's really where most of the new housing construction happens. So that's creating a challenge now for home builders because they're having to compete with additional resale inventory coming into the market, right? I mean, for the last number of years, builders have had an enormously good run, even though rates have been high, because there hasn't really been much competition in the resale market. That's changing now, and so what's interesting about what's going on with housing is, a couple of years ago, housing residential investment wasn't doing great, but units under construction were going up. Home prices were fine. Now, units under construction are kind of plumbing new depths, and home prices are contracting. I think that's an interesting kind of wrinkle. And it might mean that people are a little bit too sanguine, meaning investors are a little bit too sanguine on what that might mean for the employment markets, right? I mean, if you're not making new homes and you're not getting more commissions on the homes you sell, what does that mean for employment in housing related industry? I would say
how big, without just saying, okay, housing is X, right? Let's go back to trickle down economics here. What's the ancillary effect in home building, right? I mean, obviously you've got lumber and you've got transportation and you've got realtors and you've got all that stuff. Any ideas to what maybe what multiple?
I mean, I could Google it, but if I did, it would probably be some inflated statistic because that's what everyone thinks their industry is the most important industry, right? So, you ever see those like flow charts with Boeing? It's like, oh, look at all these it's like right. So that's the most important thing. You do the same thing with housing, I'm sure. I'm sure the NAHB has some inflated statistic that makes them more important than they actually are. But what I would just say is, look, I mean, there's obviously a lot of manufacturing that goes into homes. I mean, you have like wood product manufacturing, you have, durable goods, right? So, furniture, appliances, floor coverings, single family detached comes with a garage. So you have to fill that with a car, maybe. I mean, so you can kind of go down the rabbit hole, but, I think it's important. But as I say, like, to me, what hasn't happened yet is that you haven't really seen labor market stuff related to housing crack. And I think that's probably changing now. I mean, it's not really widely known, but, residential construction, when you look at residential construction and, residential sort of contract work, the employment numbers there have already been coming down. So, I think that probably gets worse before it gets better.
Yeah. Well, let's talk a little bit about seasonality because there is this old quip in the market called sell in May and go away. It's funny how if you can make something rhyme, people tend to buy into it. The reality is, if you look at the data, for equities in particular, if you take that back into the start of the S&P 500, which was essentially back in 1957, there is a seasonal tendency. And in fact, I would say if you're going to use sell in May and go away, that's certainly more applicable to cyclical names versus defensive names than it is to the market as a whole. But seasonality really starts to kick in around the middle of July, which just happens to coincide with second quarter earnings season. And I think part of that is this optimism that analysts tend to have. It's just a human behavioral trait about the year ahead when they're making their estimates and their projections for the coming fiscal year. And so in January, people get pretty ginned up. And I think by the time the second quarter comes around, they realize that those expectations might be a little heavy, and they need to adjust. And so what you really end up with is a sell in July and then come back in October. So I guess if we had to put a quip in that, it would be say goodbye in July and the bear's over in October. So maybe that'll catch on. But from a seasonal perspective, that's how that tends to play. From an overall market standpoint, as we mentioned, 475 being important on the 10-year yield, still in this range, which is probably good news, at least for now, in terms of Steve Pavlik's world and DC and what they're able to do. But we'll obviously still continue to keep an eye on that. But in terms of the overall S&P, still really in a very good spot. We had that Brett thrust a couple weeks ago. Now we've been able to follow through from most of that. We don't yet have the trends actually kicking in yet, which I know is a little frustrating for trend followers. But that's why we use momentum, because momentum will often cue this up well before the trends do. So that to us is important. But if you're looking for support levels, it's really 5,700 on the S&P. Resistance would be back at that previous high, which is right around 6,150 on the S&P. But while we're not in an uptrend, we do have enough momentum that suggests that trend will change as we go forward. So I do think we consolidate. I think we're just kind of kicking around here, burning some of that off. But from a sentiment standpoint, and I do think that this is important, we obviously had a sentiment extreme back at during March and at the beginning of April. Those tend to be good. They tend to be good for a extended period of time, out at least 6 months. Oftentimes that will take you out indeed out to 12 months. So there is this kind of long runway with these sentiment extremes. We're just back to neutral now. And, some will look at that and say, well, that's a problem. People are no longer as pessimistic. It's actually not a problem. In fact, one of the things that we look for is sentiment to get too bullish too early. And that actually is another sign of momentum. And as we've said so many times here on this pod and in client meetings, sentiment is really just a reflection of historic return. So if you're going to give me a big 13-week historic return, I'm going to tell you where sentiment is, and I can do that with more predictability. I can predict sentiment if you give me returns more than I can predict returns if you give me sentiment, and that's exactly what we're seeing here. So we would actually say where sentiment is today, given those 13-week returns, it's not outsized at all. So I think there's still something to that. Let's go to our own Harry Chen for the mailbag. Harry, what do we have this week?
Okay, today we have the question from Matthew Stotts. The question is, given the market's reaction to the big beautiful bill clearing the first hurdle by passing the House, how high do you think bond yields, particularly long-term, might go? Thank you.
All right. So given the market's reaction to the big beautiful bill clearing the first hurdle of the House, how high do we think bond yields will go? Neil, I'll toss that to you here. I've got some.
So I guess this is like a more interesting kind of. I mean, I don't know, but I also think the premise of that question, it kind of makes an inconsistent assumption about the forward-looking nature of the financial markets, right? It's like breaking news, everybody. The unified Republican government wants to pass something. In this case, it's the president's signature piece of legislation from his first term. So at some level, I would argue that this has largely been priced in sometime after the election, right? Because I don't think there was ever any doubt that they'd get this done. the real question is how much they, they kind of move on the sort of little tax giveaways, like, no tax on tips, no tax on overtime, no tax on Social Security, etc. But I don't think that there was ever really any doubt that this was going to get over the line. This is something they had to do. So why would you think that that's not already priced in? In which case, when they sign it, nothing really should happen. The issue is the extent to which, you're seeing some fiscal offset from tariffs, right? That's obviously not going to be scored by the CBO. And I would just say that, to me, like, the most interesting things with respect to the rates market hasn't really been happening on days of like fiscal policy news. It's been happening on days of, well, trade policy news or stuff that's been happening globally. Like, is there a big, beautiful bill making its way through the Japanese Diet, or a big, beautiful bill making its way through Germany? Well, in this case, it's the defense stuff. But in other words, there's a global factor to what's driving up interest rates. It's not that people don't want to hold US long bonds. They don't want to hold long bonds. Generally, the curve is steepening, has been steepening, not just in the US, but everywhere. So, to me, that's not necessarily something that's being driven by US fiscal dynamics, at least not in the way that people are describing. Right? It's sort of like, you go back to last week. It's like, oh my God, it's the fiscal bill. And literally, as people started lighting their hair on fire, you saw like a 15 basis point drop in the long end. It's just, I don't know that it's really about fiscal. And I think more importantly, you're just making an inconsistent assumption about how forward looking the markets are. It's like breaking news, everybody. America's been running like massive budget deficits for years. I mean, it's like
100%. I would agree. I mean, look, I've been in this business for a long time, and I've looked at it historically for a long time, even longer. And I get the logic, and I like to say, we're not carpenters, right? Not all of our doorways are square and our beams are plumb, right? That just isn't the way the equity markets work, or markets generally. And so it's really easy to draw these assumptions about government spending. And look, eventually all that is true, right? But that's a long path. And so, probably the biggest mistake, or one of the biggest mistakes I've seen consistently made in this business, is people reading too much into what's happening in DC and translating that into a bearish message for the equity markets. In fact, that's one of the reasons why our policy uncertainty index is such a good contrarian indicator. The higher the policy uncertainty, the better the forward returns. Washington just doesn't really matter that much to what we're doing. Now, again, I do believe in Biden vigilantes. I believe in all that stuff. But I think Neil's point is a very important one, which is this is not a U.S.-centric issue. This is a global issue. And in fact, if we had to point to what is happening globally, is this because there's such a great boom in global demand, in economic growth? I think it's probably just this continued residual unwind of the yen carry trade, right? I mean, if you think the yen was essentially the financier of asset purchases for decades, and that had started to come under pressure in the last, call it year and a half. And so I think there's still some of that where you don't have this borrowed capital and the ability to use that to lever up with higher yielding assets, even though this is the point where actually that makes the most sense, with yields trading right around 4.5% to 5%. Steve, what's on the docket next week in terms of DC? What do we have? What should we be watching for?
Well, sure. Again, looking just abroad real quick, I look for any headlines. I think Tuesday and Wednesdays at OECD trade gathering. So I think that'll be important. And then closer to home, Congress returns. So it's going to be what dials does the Senate, try to adjust there. We talked a little bit about how they might make the business taxes more permanent. I think there's probably a decent chance that maybe they try to scale back some of Trump's campaign pledges with respect to interest on, or tax on auto loans, the no tax on tips, things like that. And they might be able to do that in terms of the time horizon as well as the income threshold for eligibility. So that may be one thing to keep an eye on. But that'd be the big things here.
I don't know what I just did there. All right, so much for my production skills. Hey, Neil, what's going on next week in DC? Actually, you have a number coming out in like 10 minutes, but we won't preview that. What's going on in the economic world next week?
Well, it's a big week for economic data, particularly the labor market. So we have the employment report for May coming out next Friday. Markets are looking for a slight step down in employment growth, 130,000 for May. I'd watch the unemployment rate. I mean, I've been looking at jobless claims, continuing jobless claims. That means that unemployment probably goes up. And we'll also get data on manufacturing. The ISM manufacturing PMI is coming out. I'm not expecting anything meaningful. There. In terms of manufacturing, the one good thing I think you can say is that we had a strike at Boeing last year, and we're kind of working that off, and that's providing some lift to manufacturing activity. But in terms of like the supply chain reorientation, the uncertainty around CapEx. That's the weakness in housing we discussed. I mean, those are all sort of things counting against manufacturing.
Well, when you think about your June data points, right? So May is in the books essentially. When you think about the June data points, give me your top three kind of in order that you're going to use to assess kind of where we are versus where we've been.
Well, I think it's going to be, we have the employment data number one. That's next week. Once the employment data comes out, then it'll be claims that kind of take over in terms of significance. I do think that continuing claims will continue to move up, at least over the next 4 to 6 weeks. And then it'll be consumption. We're seeing some evidence that, Memorial Day sort of related spending wasn't that great. People are kind of using the weather in the Northeast as a reason why that might be, but it is what it is. So it's really, you get the consumer right, everything else in the U.S. economy tends to fall into place. If you're
no doubt about that. Well, discretionary stocks are a mixed bag, so we'll see. But that should start to actually move. The worse the data gets, and the better the discretionary stocks do. I know I did say that correctly. I know it sounds counterfactual, but it is in fact just another one of those perversions of this market and this business, where what you expect does not necessarily translate into returns. What we're going to be watching for is relative performance. And actually, I think what Neil just hit on there is really important, because that's one of the things to watch for. If we start transitioning, which we already have, away from beta towards momentum, momentum has within it the seeds of the leadership for the next cycle. So if we start transitioning away from beta and into discretionary, that's a good sign. If we start transitioning away from beta into staples, that's a bad sign. So we'll be watching for this continuation of what on a relative basis is making new highs. Where's the momentum going? Because again, that is tomorrow's leadership. Tomorrow's winners are today's winners, frankly. So that's going to be a really important point for us as we continue to slug through the summer, is where that transition is, and then what that is in terms of building that narrative as we go in for the remainder of the week. Well, I'm not Steve Duttenhofer for sure, but thank you for joining us this week. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and our YouTube channel. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavel.
Thanks. We'll see you.